Hello and welcome to Sectors Up Close. I'm Matt Gooderick. Well, our guest today is John Stoltzfus, the Chief Market Strategist for Oppenheimer Asset Management, who's going to discuss two sectors today, information technology and industrials. Well, this double-barrel strategy represents growth versus value stocks. There has been much debate about whether investors should rotate out of high-priced tech stocks into lower-priced dividend-paying companies like industrials. Well, the S&P 500 information technology sector is dominated by your mega-cap technology stocks such as Apple and Microsoft, as well as payment companies such as Visa and chip makers like Nvidia. It's up 37% over the past year. Compare that to this index. The S&P 500 Industrials Index includes Union Pacific, Honeywell and Boeing in its top five. It has underperformed the wider market, up a meager 6% in the same time frame. So why combine them? Well, let's ask John Stoltzfus of Oppenheimer Asset Management. John, many thanks for talking to us. First things first then, what's the thinking behind investing in these two sectors and why now?
Well, at this point, what we're seeing, in our view, is we are poised to approach a recovery in the global economy as well as in the United States economy. It would prescribe that investors need to be exposed to growth as well as to value sectors which offer an opportunity to participate in this recovery. We have seen technology outperform and other growth issues outperform for the last 2 years, while value has underperformed. But from late September last year, we have seen value beginning to outperform growth. We think it's an opportunity to be exposed to both sectors at this time and capitalize on that expectations of a global economic recovery as COVID-19 is put into check by widespread vaccinations.
Yeah, I want to ask you specifically about tech stocks. You've compared technology today to that of the automobile in the early 20th century, but how concerned should we be about the risk of buying them now, given their prices, John?
Well, I think it really depends upon the per stock issue as to how high valuations are. If you consider the broader index of the information technology index, there are plenty of technology stocks that, while trading at richer multiples than usual, are not at stratospheric multiples. They are also companies that are the core of the technology that drives both business as well as consumer trends today.
And you describe this strategy as a growth and value barbell. How exactly does that work?
Well, a barbell essentially means you have two components in your portfolio that are, in a way, are at opposite ends of the spectrum. You have technology, which is the growth area, an area where technology today is ubiquitous, serving both businesses and the consumers. And on the other side, you have the industrial sector, which appears from the outside perhaps somewhat old guard in terms of manufacturing. So you've got growth and value. We do not believe that investors are moving out of growth. They're just moving into the value sector to get better diversification, to capitalize on what we expect will be a global economic recovery on back of the US and its allies and other countries around the world putting a check to the spread of COVID-19.
Really interesting stuff, John. Many thanks indeed. That was John Stoltzfus, Chief Market Strategist at Oppenheimer Asset Management. Well, before I go, here are some of the top stories in the technology and industrial sectors. US data analytics firm Palantir Technologies reported a 40% rise in sales in the second quarterly results since going public in September. Known for its work for the CIA, Palantir's net loss narrowed to $148 million in the quarter on revenue of $322 million. Shares in Japan, SoftBank closed at a record high in Tokyo on Tuesday on the back of the recovery in the value of the firm's technology portfolio. Its shares rose 4% to push its share price above the 10,111 yen reached in February 2000, the height, of course, of the dot-com bubble. Its shares have risen 300% from lows hit last March as the pandemic savaged its portfolio. And finally, the private plane synonymous With the jet set, Elite is nearing the end of the runway. Learjet is ending production this year, following a slump in demand due to competition from newer and less expensive rivals. Well, created by American entrepreneur Bill Lear, the Learjet first took off from Wichita, Kansas in 1963. Some 3,000 have since taken to the skies, capable of flying close to the speed of sound. Despite its performance, it just couldn't compete with rivals on cost. And that is your roundup of the information technology and industrial sectors. I'm Matt Gooderick, and this is Reuters.